All predictions that Dr. Michael Burry made are turning into reality. Just like the author R.L. Stein's storybook monsters starting to come to life in the movie Goosebumps. In early 2021, Michael Burry predicted we would face huge inflation for years to come, and warned investors about the upcoming stock market crash. But no one listened to him. But to everyone's surprise, all of his predictions came true. The US is facing unprecedented inflation, and the stock market is making new lows every month. The Nasdaq is down 32%, and the S&P 500 is down 23% year-to-date, and yet there's no end in sight. He used a dead cat bounce prediction to warn investors to avoid getting trapped into buying the bear trap rally, and since that date, the market's down almost 15%. The most surprising and concerning prediction of Michael Burry, which convinced me to make this video, is alarming. Michael Burry tweeted, "We're not even close to the bottom." This means investors are not paying due attention towards the gravity of the situation. Worse is yet to come. And to survive that financial tsunami, people must understand and prepare accordingly. So in this video, we will discuss why Dr. Burry is so skeptical, and what are the solutions he's proposing to survive the upcoming crash. According to Michael Burry, there are three main factors that will cause the collapse worse than American economy's recession in 2008. Considering these three factors, Michael Burry has sold almost all of his stocks. You'll be surprised to know what he said. In his tweet, he said, "Inflation appears in spikes. When the spike is resolving, it won't be because of Biden or Powell. It'll be because that's the essence, the nature of inflation. Resolves, fools people, and then comes back. When it comes back, neither the POTUS nor the Fed will take credit." The attached chart shows the inflation cycles that occurred in the 1940s and 1970s. The first inflation spike was followed by the larger second one, which can be clearly seen. This is because the economy usually collapses after the first inflation spike. This forces government to print money to safeguard the economy. However, governments don't know that inflation returns in a more terrifying manner. The credit goes to the concept of velocity of money. We can calculate its value by dividing GDP with the money supply. For instance, an economy transacted pizza only. 3,000 pizzas were sold in this hypothetical economy in 1 year. The price of each pizza is $10. We can calculate the GDP by multiplying 3,000 by $10. So let's assume $10,000 is the total money supply. We can find the velocity of money by dividing $30,000 by $10,000. So the answer is 3. This implies that the average US dollar was used in 3 transactions around the year. This is the velocity of money. Over the course of the past few years, the money supply has increased radically, yet the velocity of money has failed to pick up. Velocity is nominal GDP over money supply. QT plus higher rates started to push M2 down. Yet we're seeing a tick up in velocity, emerging from a narrative obscurity. In 1978 and 79, rising velocity trumped falling money supply to drive inflation higher and higher. The redux would shock. The attached graph is representing the velocity of money and money supply. The white line here shows the velocity of money going from 2.2 to 1.1 in 1990. This shows that in the past, the average dollar has been transacted 1.1 times a year versus 2.2. According to the latest data, it can be seen how well the velocity of money is rising again. If the velocity of money continues accelerating, this means inflation will be stronger. In another graph, Burry showed the nature of inflation, which is cyclical. In the 1980s, inflation returned, roaring at 15% plus annually. Realize inflation has always been peaky, and it has never been just one peak. So it resolves, a brief deflation in the 40s and 50s, or dissolution in the 70s, and then comes back. An inflationary cycle generally spans years, and inflationary eras have spanned decades. Human nature. The attached graph showed CPIs over the years and annual growth of US GDP. The correlation between these two can be seen. CPI goes up, meaning the GDP rises as well. This means with the crash in prices in the coming months, the economy will collapse too. With an overall economy going down, certain percentages of people will suffer more than the others. When something falls from the sky, it's not the fault of whoever put it up there in the first place, unless the Fed put it there. Keeping in view the upcoming issues, the Fed is discouraging expenditure. However, the fiscal government is still spending money. The Biden administration is releasing spending bills. This will be adding to the inflationary wave. Burry explained the phenomena in a tweet where he said, "With recent spending bills, including the student loan forgiveness now approaching $2 trillion this year, we have the emergence of the fiscal put, not just for COVID anymore, and will be as good for America's economy as sugar for babies." Burry has very well explained the current economic situation with the help of analogy of sugar. When one gives sugar to a baby, he feels good. But with passage of time, he may become habitual of taking more and more sugar, eventually causing bad effects to his health. The way the fiscal government is acting is the same. They boosted the economy by spending trillions of dollars in the short term. However, in the long run, it'll crash. The economy will expect more money, and it will lead to a second, more severe wave of inflation. And though a strong possibility of the second wave of inflation is there's another, more serious issue. The White House redefined what is a recession in July of 2022. One of the excuses for this act is that the unemployment rate was at 3%, which is an all-time low. In 2020, the unemployment rate was 15%. Therefore, 3% is still bullish for the economy. It's assumed that people aren't being laid off. The economy is strong. However, this assumption is false. In fact, unemployment rate is a covering factor, which means that this number is only the lagging factor behind recession. Hence, if the unemployment is low at the moment, it will increase in the near future. The white-collar employment bubble is bursting right before our eyes. And the longer it takes the redundancy to disappear, the more permanent the decline in employment will be. Work from home will, in time, be seen as a culprit. The approaching crash of employment will affect the entire economy. Though this is a huge issue, there is yet another one more serious than this, i.e., margin. It's when the investors take loans in order to buy the investments. And theoretically, taking margins is not bad. However, it is pretty darn risky. For instance, you invest $50 in a brokerage account and get another further $50 in the form of a margin loan. If the portfolio goes up 60%, then your assets will be worth $110. On the contrary, if they go down by 60%, your assets will have a worth of negative $10. Yes, this is the case. Margin calls will not let your portfolio go to negative in actuality. It's when the equity drops below the essential percentage of the portfolio. Margin calls force one to deposit some extra money in the account. If you will not comply, then the broker will sell your positions without prior notification and will charge an extra fee as well. Margin works great while on the upper side and performs worse on the bearish side. At the moment, we're on the verge of the largest bubble of margin in our history. Due to alternative investments such as futures and options, margins have become riskier. Margin calls occur easily because of enhanced volatility. When an investor gets the margin calls, as the broker will be selling assets, therefore asset prices will be dropped. This situation will allow others to get margin calls and lowered prices and even more margin calls. Credit card debts further explode the scenario over the period of the last 5 years, rising up to $4.6 million. The reason behind this huge rise is the ease to access credit cards. Goldman keeps stepping in it. AIG was rescued to save Goldman from the other subprime issue that everyone swore would not be contagious. Goldman's Apple Card, more than a quarter to subprime borrowers. 3% loss rate on that business as of Q2. As discussed earlier, recession is a regressive tax, implying that the lower class will be hurt harder. Goldman has given more credit cards to the lower classes. With the rise in inflation, the lower class will be suffering harder. Margin bubbles and the credit card bubbles will cause a collapse in the economy. Margin leverage isn't what it seems because options. VIX isn't what it seems because futures. Consumer credit isn't what it seems because inflation. QT is exactly what it seems. He means to say that volatility, margin leverage, and consumer credits are worse than as they appear to be. On the other hand, when Fed pulls out, the money situation will be horrifying. Today, I wondered if this could be worse than 2008. What interest rates are doing, exchange rates globally, central banks seem reactionary and in SIA mode. One of my analysts said it was spooky that today I would wonder that Alpine anniversary. Though Michael Burry is criticized for predicting the crashes only, his track record has been great. No, we have not hit bottom yet. Watch for failures, then look for the bottom. 2 SPAC EFTs failing is not near enough.